Good morning, everybody. Trying to slurp my tea quietly so you don't hear the gross slurping sounds while I wait for the camera to come to life. I hope everyone's well. It's Wednesday, the 31st of January, and I wanted to get this out yesterday, but time got away from me. I think in slow motion, we are at a critical tipping point in the housing market. You won't see it or feel it overnight. But I think that the non-stop, everyday, increasing numbers and increasing intensity of bad news about jobs, businesses, and the economy and mortgage lending are finally going to start getting people to wake up, especially as now everyone I'm talking to says that they know people being laid off, they know people who've got no work, they know people whose income has dried up. So the reality of what I have said for nearly 2 years now, which is that we're going to be facing a 1990s style recession, sadly appears to be coming true. Now, let me run through very quickly just the headlines of what I want to go through in this video. So in no particular order, first of all, yesterday, the Insolvency Service announced that company failures had hit a 30-year high. And links to everything I'm showing you on screen now are all linked to below, so you can check it out for yourself. Company failures hit a 30-year high, the highest annual number since 1993. I'll come back and go through this in detail in a moment. The Bank of England released December's mortgage approvals, and buried in there, it said the annual growth rate for net mortgage lending was flat for the first time since the series began in March 1994, a new series low. So that's net mortgage lending being the lowest since they started recording it in 1994. And we continue to get more and more job cut announcements. I mean, this is an international one. It's UPS, but every single day. And yesterday we also had Sky News announcing. So this is UPS, which is obviously international. That's 12,000 job cuts. But we also had Sky News announcing 1,000 job cuts, Channel 4 announcing 250 job cuts, and all of it coming day after day after day. Last week we had Lloyds Bank doing 1,600. We had John Lewis announcing 11,000. I mean, no one's adding all this up and doing the overview of what this means for the economy. I find it surprising that on the news this morning on Radio 4, they were reporting Labour's pledges about bankers' bonuses. They're not going to end cap bankers' bonuses, and they were reporting other stuff, which is a Tesla shareholder meeting. Something came up, and I thought to myself, really? Do you not think any of those figures out yesterday were newsworthy? Why aren't you reporting the worst company failures in over 30 years, or in 30 years? So let's just run through this. By the way, the conclusion of this video is going to be that I think that this is going to create a tipping point where sellers are going to be motivated to drop asking prices faster and start to accept lower offers. And buyers who need to buy a home and who have a high deposit or are cash buyers are going to start finding more opportunities to actually buy what they need at a price that feels reasonable, even given the economic headwinds we're heading into. All right. So that's my point. For some, but not all, right? If you are a high loan to value borrower with a small deposit, it's a potentially very dangerous time to buy unless you find a bargain. And finding bargains at the moment, there is no shortcut to it. You must be out viewing properties with agents as often as possible in order to be in the right place at the right time when a property comes along where the seller is motivated enough and is prepared to accept an offer that you feel safe making, that you feel somewhat offsets or minimizes your risks of negative equity. All right. Let me get through this because I think you add these things together, and I think we're also going to talk about the fact that the way that the Bank of England's December mortgage approvals was reported yesterday was highly misleading, and I really will go into the details of that to show you so you can make up your own mind. Right, so just quickly to run through the details of this article. So it was the Insolvency Service that revealed 25,000 firms in England and Wales went bust last year. Okay, up 14% on 2022, the highest annual number since 1993. Now, the Everything's Okay crew yesterday pointed out to me that, but there are loads more businesses now. So as a percentage of overall businesses, it's not as high as the 90s. That is true. That is true. That is a fair point. As a proportion of companies, it's not, sorry about the slurp. It's not as high as the 90s, but still the total number is going up. And the point is, what does this mean for the jobs market? I wanted to get to a particular comment here. So Julie Palmer, the partner at insolvency specialist Begbie's Trainer, said, thousands of businesses have been pushed into insolvency due to a combination of interest rates that we haven't seen in over a decade, inflation, and weak consumer confidence and rising input costs. Now, to all those of you who were watching me 18 months ago, when all of those four things were already in existence, that's why I said back then that this scenario was a mathematical certainty. It's why Housing Stig, Alex, said, with all of those things, which are now there for anyone to see and to verify, it's going to push companies who are very highly leveraged into insolvency. And there will be company failures and there will be job losses. It's a mathematical certainty. Okay, and she's now confirmed what I was saying back then, which is when this happens, that happens. She goes on to say, and this is really, I think, the most powerful paragraph in this article. With more businesses entering insolvency in 2023 than during the financial crisis, just let that sink in, right? Last year, never mind this year, right? Last year, 2023, had more businesses entering insolvency than during the global financial crisis of 2008. Right? Let that sink in. She says, economic conditions must improve quickly, which they're not going to, because we can see that. Otherwise, the fight for survival in 2024 might be a step too far for the battered and debt-laden businesses that managed to survive last year. Okay. So what she's saying is that's last year and the conditions have got worse. And unless they get better, it's going to be worse this year. Think about what that means for jobs a year from now and 2 years from now, because this is a slow process. And someone called Mark Fuld from Evelyn Partners says, while in terms of interest rates and prices, the general feeling might be that the worst is over. Okay, so maybe interest rates won't go any higher. And maybe price inflation has come down to manageable levels. While that's the general feeling, the trading environment, which is a different thing, remains pretty onerous. And I think he's putting it gently. There are some signs of optimism with hopes that they cut interest rates. Okay. You can't be optimistic because of a hope. You can be optimistic because they've said something, but hope is not a cause for optimism, I don't think. I think that's misplaced. Retail and hospitality firms are set to be hit hard by an incoming increase in national wage. They're already battered. And construction firms are suffering amid a downturn in the housing market from higher interest rates. Okay, so that's that part. I don't want to labor that point, right? I want to come on to now the next point. So this is the Bank of England's data. Let me just make that big on the screen again for you. And I always think it's worth looking at the graph to see the context, because yesterday this was reported as mortgage approvals are up. I mean, they're up a teeny bit on November, or are they? Because, oh, look, this is seasonally adjusted. What does seasonally adjusted mean? Right. I'm going to just really go into this because I'm not saying that there isn't a use for seasonally adjusted numbers, but they are not good to be used for just looking at the last couple of months and seeing what's happening at the front line. It's good for when you zoom out for a whole year. Let me show you what I mean. So first of all, I want to show you this graph, which GS Economics on X posted, which is a very, very helpful graph. And the orange line, I can't get it to zoom to the right size. So this is going back from the last 30 years, basically, right? The orange line is non-seasonally adjusted and makes a very good case for why you need a seasonally adjusted figure, because without it, it's a real old spiky mess and it's very, very hard to get the trend out of it. So I'm not disputing the value of a seasonally adjusted figure. However, when you look closely down here, the orange line is what actually happened, the actual number before they seasonally adjusted it. And the blue line is the seasonally adjusted number. So the blue line went up when the orange line went down. When you are reporting a month-on-month result, I think using seasonally adjusted numbers is not appropriate. Let me show you what I mean. So now we're going to go to, thank you very much, Alex. Housing Stig yesterday did this for everyone, just to really make the point, right? And he's got two tabs from the mortgage approvals table and a comparison of the two side by side. Okay. Now, down here, okay, the left-hand column is seasonally adjusted and says 50,000, which is a tiny bit up from November, which is 49,000. But the right-hand column is non-seasonally adjusted, where you can see actually it's gone from 50,000 down to 36,000, which is a big drop. So when newspapers report that mortgage approvals were up in December, unless they clarify that that's according to the seasonally adjusted numbers and the non-seasonally adjusted numbers were down, it is misleading, directly and blatantly misleading, to not give the context of these numbers. Now let's just go through this. So what he's got here is he's actually got screenshots of the page on the Bank of England website. And you can see down here, the left hand, so this is not seasonally adjusted, right? Not seasonally adjusted. Just checking that's on the screen there. And down the bottom here, November 2023, 36,000, down from 50,000. Now, this second column is remortgages. Now, what someone did point out is, oh, but it's up on last year. Yeah, that's true. So up here, we've got last December, right, which was 29,000. So we are slightly up on last December. But again, going back to the Bank of England's graph, look at the trend on the graph. It is up on last December, but last December was the lowest point we've had since 2011, excluding the pandemic. So guys, I hope I'm putting a picture together here, because you start to combine the job losses, the relentless job losses, with the company insolvencies from last year, which give us an indication of what's happening this year. Is it getting better or is it getting worse? Is the economy getting better or worse this year? What does it feel like to you? And then you look at the mortgage approval figures, which we know are a reliable leading indicator of what happens to house prices from all of the 30-year correlation work that Alex has done. And you combine all of these three things together and go, whew, it's not good. It's not good for house prices. But the silver lining here is that it is good for buyers who are in a strong position. So what I've just shown you is what I'm hoping, when it's put together, will start to make anyone who's actually looking at the housing market with an open mind go, there are no prospects for house price growth anytime in the next year or two, in my opinion, at least, right? Certainly not this year, very unlikely next year, because of how slowly this plays out. So if 2024's company insolvencies and job losses are worse than 2023's, the knock-on effect from that will be into the 2025 housing market because of how slowly the whole thing moves. Even if they do lower the Bank of England base rate slightly this year, that will not be enough to move the needle against the worsening job market conditions. On the back of these job falls, we are going to see falling wage growth, and maybe real wage growth will turn negative again if it hasn't already by the time figures come out. So all of the metric inputs that we know are a strong correlation on house prices are pointing down. This is what you can see if you decide to make your decision based on actual data that you can verify, Bank of England data, insolvency service data, and companies announcing job layoffs, rather than looking at the headlines that tell you there's optimism about interest rates and that's going to make house prices go up, and mortgage approvals were up in December. No, they weren't. No, they weren't. Don't say that. Mortgage approvals were not up. The seasonally adjusted figure was up, but that is misleading of what happens. They're actually down. And year on year net mortgage lending that nobody reported on yesterday, and is arguably one of the strongest overall indicators for borrowing in the housing market, is at its lowest. The year-on-year growth is at its lowest since they started recording it in 1994. Those are the verifiable facts from which anyone who can do their 2 times table can figure out house prices don't have a chance of recovering anytime soon. Anytime soon. Okay, because of the slow motion effect of this. So this is good news for people who need a home, are happy to be paying a mortgage rather than rent, are happy to factor in some further house price reductions because they're not planning to move for a long time or at all, and who are confident enough in their job security or their financial security that they feel that the risk of being trapped in negative equity is very low. It's also a there's nothing to lose scenario for buyers with a large loan to value who go, okay, we've got a very small deposit, 5%. There's still a government guarantee scheme for 5% mortgages. Not much uptake because lenders aren't doing it. But if you could get one, and you just go, if we lose our 5% deposit over the next year or two, well, that won't cost us any more than we would have been paying out in rent in the meantime. Therefore, we can buy now, because maybe we don't have a family and therefore we're not worried about that happening. We can buy now and knowingly accept the risk of negative equity and being stuck in this house that we're buying for the next 5 years, maybe 10 years. If you are able to go, you know what, if we can buy that place, happy to be stuck there for 10 years if that's what happens. If you accept that as a risk, if you accept that your equity might get wiped out, but you feel that either your job security and your ability to keep up mortgage payments is good enough to stay there no matter what happens in the economy, or you've considered the possibility that might lose my job, might lose my house, not going to be any worse off than we are now. If you've actually considered that and accepted that, then it's now is a good time to find bargains. Now, the bargains are not the majority of properties yet. That's going to be coming later this year, early 2025, I think, is when there's really going to be a lot of stuff. But if you don't want to wait to buy a home, you will find increasing, every single day, there will be more sellers changing their mind about what they're going to accept for their house as the reality of all this economic data sinks in and they go, there's no point in waiting. If we wait, we're going to get less and less and less. And if we want to move, we have to bite the bullet and accept the offers we're getting now. What offers are we getting now? And if you can find that home that's been sitting on the market for 6 months, just sitting there, the price hasn't moved because they don't want to advertise it, and you go around there and no one else is looking at it, and you are the only offer, and it's a good enough offer for them to take the hit so that they can move, and a good enough price for you to accept the risks of the job market, the economy, and potentially negative equity if you've got a large loan-to-value mortgage, and you feel you've offset that risk, then there are opportunities out there. Not for everybody. Not for everybody. And I'm not saying that there are loads of bargains and you can go out and pick up a bargain easily. That's not what I'm saying. That time will be coming in about a year from now, roughly, depending on where you are in the country. Okay. And there will be some areas where, because the local economy is very strong, house prices won't fall. There will be some areas like that, okay? Because every housing market is really a microcosm of its local economy. And if there's a very strong local employer who's paying very good salaries that are higher than inflation and good job security, and therefore there's high demand for that area, those pockets will resist house price falls, or certainly resist the worst of them. But other areas where the opposite happens and where a large employer decides to close down or lay everybody off, that's where you're going to see even worse house price falls than I have forecast. Okay, that's what will happen. It'll be highly localized, hyper localized housing markets. And nobody, not me, not anyone, can forecast those local markets. You've got to be out there yourself, viewing the properties, seeing what's selling, what's not selling. You'll very quickly, if you're out there viewing and talking to agents, you will quickly get a feel for your local market. Now, someone on yesterday's live stream with the agent John Durrant said, but if we're just getting out and viewing, aren't we going to be seen as time wasters by agents? No, I'm not suggesting that anyone wastes anyone's time knowingly. If you are proceedable and can demonstrate to an agent that you're proceedable, even if you're maybe not in a position to actually exchange for 3 months from now, but you can be transparent about that and say, my leaser or the source of my funds is guaranteed to release in March or April. So I'm looking now. Agents will be that's okay, that's good. Yeah, if you've got the funds and they're definitely going to be released then, and you've got your mortgage in principle based on that deposit. Yeah, well, this is good. So number one is make sure you've got your proof of finances, both the mortgage and your deposit, but don't say you're ready now if you can't exchange till 3 months' time. And being transparent will buy you credibility points. Number two, do not say to agents before you have viewed stuff, well, that's overpriced. I won't be offering asking price on that, because they will consider you to be highly likely to be a time waster. Even if they're wrong, that phrase of saying, well, I won't be paying asking price, it's just, there's nothing to be gained from saying that. What you say is, I'm in a position to proceed. I would like to view that property, please. Right? That's it. Oh, well, can you afford the property? So, I'm in a position to proceed if I like the property. Let me view the property. And if they push back, say, no, I want to view that property. So that you can start to get a feel. It's just what I'm saying. It's not unrealistic for a buyer to go and look at 10 properties before they make a decision. So line a few up and say to the agent, I am viewing several properties, 3, 4, 5, and tell them which ones you're viewing as well. We're in a position to buy. We want a home. We want to view. Yes, we're hoping we're not going to be overpaying, but until we view properties, we can't tell you what our offer is. Okay, so agents, a lot of agents, especially the ones who've overvalued the worst, are feeling very defensive about what's happening in the market now. Understandably, their companies, their businesses are at risk. Maybe their jobs are at risk. Some of them, not all of them, the good ones are feeling strong because the good ones are listing properties at a sensible price, and they're getting offers and they're getting sold, right? No one is pretending that the housing market has ground to a halt, but it is stagnated or a bit constipated, as I've called it a few times. And this is where the good agents are doing are getting the sales done. They're getting people moved. They're getting buyers in. They're getting sellers out. And the weak, poor agents who rely on nothing but overpricing to get business are really struggling. Right, I've got to wrap this up. Um, that's right. There was what. All right, man. I'm going to take this one comment because hi, Charlie. So, man on YouTube says, "Hi, Charlie. Vendor refused to negotiate for reduction in price or even share the repair cost. This is after survey report of urgent repair prior to exchange." Okay, this is quite a common situation, and this is the approach I would recommend to anybody. The seller's reasons for negotiating or refusing to lower their price may be for a couple of reasons. One of the reasons might be that they have already agreed their onward purchase and they cannot accept a reduction from you without being forced to renegotiate their onward purchase, which they're not keen to do because maybe they're sure that they'll lose out. So it might be a situation where it's not that they're being unreasonable, it's that they are just afraid of losing their onward purchase and they cannot. Maybe they've tried, maybe they've asked, they just cannot do it. That might be a situation. Or it might be another imperative that where they are simply not able to go lower than they've agreed. If that is the scenario, then someone in man's position has a decision to make, which is, do I want to risk losing this purchase for the sake of this repair cost? In which case, you say to them, I'm sorry, this is a reasonable thing for us to share the repair costs. Because I think, honestly, sharing the repair cost is an absolutely reasonable thing to propose. Or would losing the purchase be something that you would kick yourself after over the sharing of the repair cost? Okay, and I had someone ask me this very, very question. Someone on a private message to me through my private movers Q&A group. Where I gave them this exact advice, and they decided that they were going to proceed without the reduction. They were going to continue to buy and accept the seller's refusal to lower their price because they could afford it. It was still worth it to them, and they didn't want to risk losing the purchase. So that's what it boils down to. Are you prepared to walk away if they don't lower the price? If not, then the decision you should make is just to continue to pay the price you've agreed if you can afford to. Or do you refuse to do that? In which case you say to them, look, guys, I'm sorry, that's just not reasonable or fair. We will walk away if you don't meet us halfway on the repair costs. That's what I would do in that scenario. Without knowing the seller's situation or the fact that the agent might be a very good negotiator, I can't comment on that situation, but the general position is that. Wow. Okay, Jay Tour. Hi, Jay. New name on the channel. Says he's starting a job as a train driver for the job security and because of these ridiculous house prices. Imran Rashid says, hi, Charlie, what's your experience with buying agents? Are they incentivized to get a good deal on your behalf? Yeah, they are, actually. I know some people think that they're not. They are. Good ones really are. And the bad ones, bad buying agents don't last around long. The good ones who are there and who are being recommended to you are being recommended because they genuinely do. They know, they understand that they are paid to find you and negotiate you a better deal than you could do for yourself. If they can't do that, they're not worth it. So, provided you find a good one, yes, they are worth it, but they are expensive. Wow. Ben B says, I've seen places here in Devon that sold last year but fell through and have come back on the market. Some reduced by 25% this year before they sold. Yeah, it's not all properties doing that, but there are some. Right, guys, I'm going to wrap it up. Listen, later today, for those of you who are watching now, I've got a live stream with my two hand-picked mortgage brokers to discuss the mortgage marketplace and how come there are some deals that are lower than the Bank of England base rate and what they think about. So they're here for you to pick their brains. 2:00 today here on the Moving Home with Charlie platform. a channel. So hopefully you can make that. I'm looking forward to that conversation. But I'll just be basically hosting a conversation between you guys and the mortgage brokers on the channel. That's 2 o'clock today, Wednesday, 31st of January. I'll see you there. Have a great morning. See you lunchtime. Bye, guys.